Thanks for joining today. We're excited to have you for our second webinar. We're doing these bi-weekly for the next few weeks. Next one's going to be with JLL talking about the state of the capital markets. But today we have Steve Pullara here from BDO, which we're excited about. Steve has been working with the Neutral Project for a few years now, and he does all of our accounting for all the projects and then also all the corporate accounting, and does a great job for us. And so today we're going to be talking about 1031 exchanges, cost segregation, and a few other items. I'll get into the agenda here. So we're going to go through a brief introduction, and then Steve's going to give us a very quick overview of what are the economics of real estate investing and what are the tax benefits of real estate investing. And not to bore you, I'll keep it very short and not get into all the jargon of taxes. But then we're going to dive right into all the different sustainability benefits that we're going to be achieving for both Edison, but I know there's maybe a few investors in our other projects on the call today, and where the tax benefits also apply to those projects as well. And then we'll go into cost segregation and studies, bonus tax depreciation deductions. And then we'll talk about 1031 exchanges, which it's the first time we're offering it, but we do have 1031 exchange opportunities on the Edison, which we're very excited about. And then we have a few question and answer, which some of you send questions in beforehand, which we appreciate. But if you have questions during the initial presentation, if you could put them in the chat, we will try to get to them at the end here. And we're going to try to wrap up at the top of the hour right at 4. And so we appreciate you being here. Just to give everyone a little bit of background on who we are. We're the Neutral Project. We're a sustainable real estate development firm based in Madison, Wisconsin and San Francisco. And our focus is building sustainable multifamily assets. We have a few projects here in Wisconsin, a project in Fayetteville, Arkansas, and one project out in San Francisco. And our guest speaker today is Steve. Steve has been at BDO for a very, very long time, as you can see with his gray hair. But he is an awesome advisor. And one of the things that Steve has done a lot of work on is cost segregations. And then also he's been studying a lot about this new Inflation Reduction Act, which we're going to talk about today. And that has been just released, and we've all been spending a lot of time digging into it. But I'll turn it over to Steve and kind of let him take it from here. But we really appreciate everyone joining and look forward to the discussion today. Thanks, Steve.
Thanks, Nate, and welcome everyone. I appreciate the opportunity to talk a little bit about the specific tax benefits of investing in real estate, and even more importantly, in sustainable real estate. So today what I'll start by talking about is just some of the general economic benefits of investing in real estate. And real estate is really a very unique asset class and has some tax advantages and economic advantages that other asset classes just don't have. You know, for those of you that have invested previously in stocks or bonds, those are great asset classes to be invested in. But in addition to just providing a cash flow stream, what happens with real estate is real estate provides a hard tangible asset that is generally appreciating in value over time. And that asset then, because of the class, because of there's being something tangible there that you're investing in, we're able to leverage that with debt and financing to enhance the returns without, having the risk be anything more than is commercially reasonable. So that's one of the first, real general economic benefits. The second is really a general tax benefit of investing in real estate. And the beauty of investing in real estate is a lot of the deductions, almost all the deductions are ordinary deductions. A lot of those deductions, as we'll talk about later, can be front-loaded into the initial years of the project. And those deductions provide a tax shelter, assuming they work for your individual situation, which we'll talk a little bit about later. Those deductions provide an ordinary income tax deduction at whatever your marginal tax bracket rate is. So if your marginal ordinary income tax bracket is, say, 40% for federal, then you get a tax benefit for 40% on these deductions. So it's a cents on the dollar. So if you're getting $1 deduction, that's going to provide you 40 cents worth of tax benefit after applying your marginal rate of return, your marginal income tax rate, I should say. So that's really a second point. A third point that is really super cool is that when real properties are disposed and sold, the gain is generally at tax-favored lower capital gains rates. Those are generally at a 20% maximum marginal rate. And so what happens is on the front end of a project, you're getting deductions at ordinary income tax rates, which can be 40%, and you're paying capital gains tax when you sell the project, and those capital gains are taxed at literally half of the rate that you're paying and getting tax benefits for the deductions for. So pretty cool. And then the last thing that's really kind of unique and specific to real estate investing is what's called a Section 1031 tax-deferred exchange, where essentially you can sell real estate that you're invested in and purchase other real estate and not pay the tax on the sale of the first property that you've sold until you sell the second property or the third property or the fourth property or so on and so forth. So you get this tax benefit. So really you get kind of what I would call the best of all tax worlds. You get the advantage of time value of money. You get the tax-favored rates upon sale. You get the benefit of the deductions at ordinary income, and you get the deductions on the front end, and you get the capital gains tax that you have to pay on the back end, assuming you don't do a Section 1031 tax deferral. So very good summary there of the economic benefits of real estate investing in general.
And Steve, just so we can clarify for that second point on the income tax deductions, if someone's in, let's just say, a 25% tax bracket, they would then get a 25% reduction. 40% in your example was the maximum amount.
Correct. Yes, that is correct. So it depends on the individual investor's marginal income tax rate bracket. And that just depends on the individual's situation, and that you should consult with your own individual tax advisor for those sorts of things. What we're trying to do today, Nate, as you well know, is try to give out general income tax information about the benefits of investing specifically in real estate and more specifically in medicine projects. So
yeah, no, I appreciate it. Thank you for answering our question. Let's move into this next section.
Yeah, so let's now talk about the very specific additional unique benefits of investing in sustainable real estate, such as the Edison project. And so, as some of you may be aware, there was very significant legislation in 2022. It was kind of mislabeled, but I don't want to editorialize too much here. It was called the Inflation Reduction Act of 2022. And the reality was that was the single largest climate legislation investment in United States history. It's $369 billion, which is a lot of money. And so a lot of the initiatives in that Inflation Reduction Act were climate related, and a lot of the initiatives extended some of the climate related initiatives that were already in place. And it also added additional incentives and credits and deductions that came about because of this legislation going forward. So it was very favorable for projects such as sustainable real estate in the Edison. One of the things I want to do real quickly at a kind of a high level is explain the difference between a credit and a deduction, because I'm going to be using those terms quite regularly here in the next half hour. And so a credit is a tax benefit that's a dollar for dollar reduction. So if you receive a $100 tax credit, that means that if your income taxes otherwise would be $200, your income tax is now $100. So it's a dollar for dollar reduction. As Nate alluded to previously, a deduction is a cents on the dollar tax benefit. So if you happen to be in a 40% tax bracket, then that $100 deduction is going to give you $40 of tax benefit, not $100 of tax benefit like a credit would. So just want to make sure that everyone understands the difference, because some people use those terms interchangeably incorrectly, and just want to make sure there's no misunderstanding or miscommunication as it relates to that. So what we're going to talk about now is these unique tax benefits that are applicable to the Edison project and sustainable real estate. The first one's called the New Energy Efficient Home Credit. For those of you that care about code sections, at code section 45L. What this credit is really to promote energy efficient homes. And it applies to multifamily projects like the Edison, as well as single family homes, right? And so this credit is basically, there's some qualification things that have to, some qualification and limitations that have to be met by the project. This credit is up to $2,500 per dwelling unit, and it's dependent on meeting Energy Star multifamily new construction requirements. And so those requirements are not simple to meet, but they're also not extremely complex to meet. And based on, our understanding of the project and the communications we've had, Edison project would meet those standards. There's also a larger credit for zero energy projects, and it's $5,000 per dwelling unit. It's a stricter test to meet from a sustainability standpoint. So this credit's pretty significant, very significant.
Which, Steve, if I can jump in here for a second, since Edison is Passive House Institute certified and Energy Star certified, we will almost definitely, obviously we can't guarantee it, but almost definitely get the $2,500, and we might be eligible for the $5,000, but we're telling investors that $2,500 is almost a sure thing. $5,000 is a maybe. And so later on in the presentation, you'll see a table where we lay this out of what all these credits mean for investors, and specifically the Edison. And we're kind of estimating on the lower end for this credit because we know for sure we can get that. And our goal is that we might be able to get the 5,000, but it's a little bit more uncertain. Sorry, Steve.
Good clarification. Perfect. So one maybe final thing about the New Energy Efficient Home Credit is that because we're taking a credit, which is, again, the dollar for dollar reduction, we don't get to double dip and also get a tax deduction for the appreciation of the cost of that property. So we get a deduction, we get a credit for that, not the deduction. But that's more beneficial. That's what we all want is credits if we can get them. So let's talk about the Energy Property Investment Tax Credit, which is the second credit that the project will be eligible for. And that's a 30% tax credit for energy building envelope components. Those components are basically solar, geothermal, wind, fuel cells, other energy property like that. So again, we have costs that Nate will highlight later for the property, that will be eligible for this 30% investment tax credit. We also believe there's also an additional 10% bonus credit on top, so it's really a 40% credit of these costs if the components are significantly U.S. domestic manufactured product. So there's the law basically said, hey, if you're using, we're trying to incent U.S. manufactured products and components for solar, for lighting, and the building envelope. So there's an additional credit available for that. So we, again, hope and believe that we'll have a 40% credit for that. And Nate, later you'll probably go into the specifics of that. So then there's one more significant energy efficient commercial building deduction that the project will be eligible for. It's Code Section 179D. This is a deduction and not a credit. What it essentially does is it allows the cost of the building based on the square footage up to $5.65 per square foot. It allows a deduction for that amount, that equivalent amount of cost, as an immediate income tax deduction. It's deductible in the year that the building's placed in service. It doesn't have to go through a depreciation life method convention. It's an immediate deduction when the building's placed in service to the investors. The energy conservation costs, that are relevant to obtaining this deduction are for those that incent costs related to efficient interior lighting systems, heating and cooling, HVAC systems, if you will, and building envelope improvement costs. And again, that's a very significant deduction. So again, it's cents on the dollar deduction as compared to the dollar for dollar credit reductions of tax benefits.
And just to clarify again, because we are getting Passive House certified, we believe that we actually will obtain the full amount of this deduction. And just to give you an order of magnitude of how big this deduction could be, we have a spreadsheet later on that we're going to show everyone, but the Edison rentable square footage is just over 400,000 square feet. So between now and that slide, we'll let you do the math, and if you can't solve the problem, we'll show you on the slide in a few minutes here, but we'll move on to the next one.
I think you baited and switched there, Nate. You didn't tell them about the quiz at the end of the
Yeah, shoot, I forgot about that. Yeah, everyone's getting a quiz after this.
I hope it's pass fail and not graded.
Or for free tax services for a year from Steve. That's what he's offering.
Okay. All right. So let's shift gears a little bit and talk about some other general but significant tax benefits for the project. And so what we're going to talk about now is cost segregation studies and bonus tax depreciation deductions. And so a cost segregation study is just kind of a fancy term for an engineer basically going through a project and, for income tax purposes, segregating and separating the components of the building into the real property components, which are fixed and immovable, and the personal property components, which are, things that we can depreciate over a much shorter tax life. They are considered for income tax purposes as personal property. Something like a chair, an appliance, a refrigerator, a stove. It gets very complex, and that's why you need an engineer, and actually not necessarily a CPA to do these studies. But the engineers go through, and for example, like a sprinkler system, the sprinkler system might be considered real property, but the fixture around the sprinkler might be considered decorative, and therefore that sprinkler head would be considered personal property as compared to the fire suppression sprinkler system being real property. So that's just one kind of unique maybe example is what we're trying to do. And really what we're trying to do with the cost segregation study, if we don't do a cost segregation study, the IRS under audit would argue that all of the costs for the building are real property. And they would argue that that's a 27 and a half year for multifamily residential property, that is a deduction over 27 and a half years, which is a fairly long period of time. It's not as bad as 39 years if it's commercial property that is not multifamily property. So that's even a longer depreciation life. And the benefit of the shorter depreciation life is this personal property gets depreciated over essentially a 5, a 7, or a 15-year qualified improvement property depreciation life, depending on what it is. And so, flooring might fit into a 5-year category, appliances might fit into a 5-year category, and then things like landscaping may fit into a 15-year category. And so to the extent you're moving something from a 27 and a half year category to a 5-year category, obviously you're accelerating that tax deduction by, 22 and a half years. So it's pretty significant. So once we segregate the property into the personal property components and the real property components via the cost segregation study, what happens is we then can take advantage of personal property being eligible for what's called bonus tax depreciation. And bonus tax depreciation is essentially like the 179D deduction, where it's an immediate acceleration of the deduction into the year that the property is placed in service, rather than over the 5, 7, or 15-year depreciable life of the personal property. And so in the bonus depreciation only applies to personal property as compared to the real property. Real property is not eligible for that. And so the bonus depreciation has been in place for quite a while. It's been in place for, over a decade. And the laws and regulations around it change a little bit from time to time. The most recent change came in the 2017 Tax Cuts and Jobs Act. And for 2018 and going forward, the bonus depreciation started out being 100%, but it's gradually being phased out under current law. It's 60% in 2024, it's 40% in 2025, 20% in 2026, and then it's slated to be 0% in 2027. But that's only because when this tax law was passed back in 2017, it had such a significant revenue impact on the federal government budget that it couldn't extend out beyond 10 years, and thus the expiration in 2017. I think regardless of what political side of the aisle you're on, Congress is probably likely to jump in and extend this at some point in time. Again, there's no guarantee, but they may even eliminate the phase out over time, because generally this is seen as a good public policy to promote investment in multifamily projects, personal property, manufacturing equipment, and so on and so forth. That's what the public policy is designed to promote here. So that's bonus depreciation. And, just a rough rule of thumb, and I hate to give these out because everybody says, oh, but you said it's going to be X, or you said it's going to be Y. A rough rule of thumb based on experience for our engineers that typically do these cost segregation studies for a project like this is it tends to be in the 15 to 20% range of the property cost that gets cost segregated and shifted from real property into personal property for the accelerated tax deductions.
And Steve, if I could just clarify one point. We put this rendering in on the left that you see here for a reason. And you see all the furniture that we illustrated. That would all be the tenant's property. Of course, we wouldn't get to depreciate that. But right. For example, the flooring, would that be put on a 5-year schedule?
Yeah, and that would be eligible for bonus. And again, I'm not I'm not the engineer that's doing this, so I don't know I don't know the specifics, but generally what happens is the engineers go through and they determine the components of the construction costs of $140 million that will qualify as personal property. And so like that, those sprinkler heads will go through and they'll go through all those sprinkler heads and they'll add up all these costs and say, okay, these are in the 5-year category, these are in the 7-year category, these are in the 15-year category. Here's what qualifies for the bonus depreciation. And then they give us that information as tax accountants to do the tax depreciation schedules.
But the personal property is not to be confused with like the tenant personal property that you sent.
Absolutely. This would be the personal property that is part of the construction costs of the project, not the tenant's, furnishings and furniture and the like.
So if we, for example, let's just say the flooring in Edison costs a total of $2 million. And I have no idea if that's correct. It's a completely arbitrary number I just pulled out of my head, but let's say it's $2 million. Then that $2 million via the cost segregation would be on a 5-year schedule. So it's 2 million divided by 5 years.
Yeah, a better example might be like the appliances, right? The appliances, the fridge, the dishwasher, all those sorts of things. Those would be definitely a better example even than the flooring. They would be pulled out, they would be separated, and they would be depreciated over that 5-year life.
But if the
bonus depreciation
pays, hopefully fingers crossed it does, then that full amount for like, let's say appliances, let's just say appliances are $5 million. Then that full amount would be eligible to be distributed to the investors once the building is placed in service, basically upon certificate of occupancy in the building opening. So then that tax year, the investors would receive pro rata, of course, a total of $5 million as a tax deduction.
Yeah, they would receive their share of the bonus percent of that $5 million, and then whatever didn't. Let's say $1 million. Let's say we're at 20%, right? So let's say of that $5 million of personal property, we're in a 20%. Let's say the current law is in place and we only have 20% and it's not renewed, or it's not changed or modified in some way, shape, or form before the project's placed in service. So then 20% would be eligible for bonus depreciation, which would be $1 million of 5. And then the remaining non-bonus depreciation of that $4 million of personal property would be depreciated over the 5-year life.
Okay. Thank you for the clarity. Let's move into this last slide before we get into Q&A about 1031 exchanges.
Yeah, 1031 exchanges are very interesting. And as tax rates, as capital gains tax rates, change throughout the years, because they're not scheduled to change anytime soon, but historically they have changed. Sometimes there's no tax favored rates going way back. Sometimes they're lower than they're not much lower than they are right now. Sometimes they're a little higher. And it just depends on the public policy at the time and the politicians at the time that agree to the laws and regulations that are set. And so what's neat about Section 1031 tax deferred exchanges, that should actually be the tax deferred exchanges in the title of the slide there. What's very neat about this is an investor can sell essentially one piece of real property and reinvest in another piece of real property without paying any immediate income tax on the gain of the sale. That gain is deferred into the new replacement property. So the property that's sold is generally called relinquished property, and the property that is acquired to replace it is considered replacement property. You have to trade up. The investor, the real property owner, has to trade up in value, and they have to maintain their equity. They can't pull equity out. Pulling equity out of real property means that they essentially took out cash out of the deal. And that's what the IRS doesn't want. The IRS thinks they're giving you a huge advantage to real estate investors that take advantage of this. So they make sure that real property investors are dotting their T's and crossing their dotting their I's and crossing their T's on 1031 exchanges. So they make sure that you're not pulling cash out, because if you're pulling cash out, then you got to pay tax on it. So if you receive cash, if you had gain of, let's say, $1 million, and you pull $800,000 of cash out of the deal, you're going to have to pay tax on that $800,000. But if you don't pull any cash out of the deal, then that gain of $1 million gets tax deferred until you sell the replacement property. Or if you sell the replacement property and acquire a third property that's also a replacement property, then you continue deferring. So you could literally continue deferring over the course of your lifetime into multiple real properties, as long as you trade it up in value and you trade it up and maintain your equity. You could do that until you pass away, and then in your estate, for estate taxes, you get a step up in basis under current law, at least. You get a step up in basis, and so you would never really pay the income tax on that tax deferred gain of the Section 1031 tax deferred exchange. So it is an exchange, and so it's a complex transaction. There's additional costs to doing it. You have to use a financial intermediary to accomplish the exchange. You can't just take the cash and write a check for the new property. So you have to go through a title company or an exchange accommodator, someone like that has to be involved. So you don't constructively receive, according to the tax law, so you don't constructively receive the cash. And so what happens then is the holding period of your investment for capital gains tax purposes ultimately tax on to from the relinquished property to the replacement property. And so then you can continue the long-term holding period, so you still get capital gains when you ultimately do sell the real estate with the deferred gain built into it. You can also, one of the favorable things you can do is you can elect continue the depreciation lives, methods, and conventions on the old real property into the new property. Now, any additional, basis that you acquire. So if you trade a property for $1 million and you buy a property for $1.5 million, so you've traded up $500,000, that additional $500,000 that you invest in the new property, you would have to depreciate under the new lives, methods, and conventions. So you get that. That's the investor's choice. That's the taxpayer's choice from the deferral. Another thing that I should mention specifically as it relates to this project or any project, Nate, as you well know, is that the real property excludes stocks. You can't like-kind exchange shares of stock. You can't exchange Microsoft for Apple or for IBM or something like that. So if a corporation owned real estate and that's all it owned, you still can't exchange one company that owns real estate for another company that owns real estate. Same things applies to partnerships. You can't sell real property and invest tax deferred into a partnership that owns real property. You have to, it's the same taxpayer that has to make that acquisition of the replacement property that sold the replacement property, and it has to be real property. So it could be certainly a tenants in common ownership interest in the real property rather than a partnership interest or a share of stock or stock in a corporation. And also, the property needs to be held for investment, which it clearly is in the Edison's case. It can't be dealer property. In other words, if you can't invest in real estate that you're going to develop and sell. So that's excluded from the definition of real property held for investment.
And
let's
just to clarify in regards to the TIC, if one were to 1031 exchange into the Edison, they would not be able to 1031 exchange out of the Edison because it is then they're converting that TIG into a partnership interest that we wouldn't be able to 1031 out of a partnership interest.
Yeah, correct. So you can't 1031 into a partnership interest, and the individual partner can't elect to 1031 out. Now, there's some planning and structuring opportunities that always arise if that is something that wanted to be done on the back end, but that's probably way beyond the scope of the project. So generally, it's the partnership that has to make that decision, the LLC, if you will, that is taxed as a partnership that has to make that decision. So it's if you've got an investment in Edison Project LLC and Edison Project LLC is going to 1031 into another property, then Edison Project LLC would do that on behalf of its partners, but each individual partner can't, make that. One partner can't elect 1031, another one doesn't want the 1031, so they want the cash. So there are some real complex planning and structuring opportunities around that, but again, that's probably outside the scope of this decision.
Yeah, I think so, because with Edison, per the private placement memorandum, the entity will dissolve once we sell the property, and so there isn't an opportunity to 1031 out because the entity is just going to automatically dissolve and the investors or members will get their distribution. The other question I had for you,
and that's very Nate, that's sorry to interrupt. That is very typical. That is very common. In these types of projects, that's the norm, not the exception.
Yeah. The other question, and since we're getting into Q&A, if there's other questions, please start putting them in the chat. Greg, thank you for putting your question in the chat. But Steve, the question is, how quickly does the exchanged property have to be purchased to benefit in a 1031 exchange after the sale of the previous property?
Yeah, great question. Exchange timing, let's talk a little bit about that. And again, you're going to want to consult, each investor should consult with their own individual advisor as to what qualifies, what doesn't qualify based on their particular facts and circumstances. So I just want to get that disclaimer out there. So the timing of 1031 transactions, they can be simultaneous. That generally doesn't happen where you're just swapping out one property for another property. That generally doesn't happen. You're swapping out one tenant in common interest for another tenant in common interest. That just doesn't, in my experience, that doesn't happen all that regularly. But generally, there's deferred, which relies on a starker tax court case case law from long ago. And that lays out that you've generally got, after you sell the relinquished property, you generally have 45 days to identify the property or properties that are going to be replacement properties for the property that you sold. And then additionally, you have 180 days after the sale to obtain and close on the replacement property for the property that you sold. And again, that's done through a financial intermediary, a title company, exchange accommodator, those sorts of things. So those are generally forward or traditional deferred exchanges. There's also reverse exchanges, and again, we're getting a little beyond the scope of the podcast here, but a reverse exchange would be where you acquired the replacement property, the tenant in common interest, for example, in Edison, before you actually sold your relinquished property. There's a safe harbor. It's Revenue Procedure 2000-37 or something like that, if I remember right. That applies. It gives you a safe harbor if you're trying to do this. Case law in this area is generally not very favorable, so you got to be a little bit careful on that one. But let's just rehash, or let's just make sure everyone understands that the benefit to the investor is that you're deferring the gain and any taxes you would have when you're exchanging these properties. And that could even be a permanent deferral, if you pass and you're trying to do estate tax planning rather than income tax planning. That's an issue that you would consult your individual tax advisor for. But what happens is now you're putting all those dollars that you've got invested to use in the new project rather than selling, paying capital gains between federal and state, for example, of 25%. So if you got a gain of $1 million, you got to pay $250,000 of tax. You've only got $750,000 after tax to invest in the new real property. So it's a way of growing your economic resources and increasing and enhancing your after-tax returns by using the 1031 tax-deferred exchange.
And Steve, I want to clarify one point. You said that if one wants to sell their current property and they have $1 million of capital gains and they pull out $800,000, that on the $800,000 they would have to pay their capital gains taxes, whatever their rate is. But they still 1031 the other $200,000 if they desired.
Yes, they would still be able to get a partial deferral. So it's not an extreme. It's not a all or nothing, right, approach to the tax deferral. It's possible to have a partial tax deferral of that gain.
Okay. I'm going to move into our next question. So the question is, how are equity distributions taxed before the property sells? And so I think he is talking about basically if we distribute let's just say $100,000 per investor. I'm just giving arbitrary numbers. How would $100,000 per investor be taxed during the holding period?
Yeah. So, good question. A lot of nuances to that I just want to be careful to make sure I answer as clearly as I can. And so the project will be taxed as a partnership. And that simply means that all the income deductions and credits of the project will pass through to the equity investors in the project pro rata based on ownership and based on the governance documents of the offering. And so what that means is there will be a tax return filed by the project. That tax return will then include K-1 forms that will show all the income deductions and credits that are passing through the project's business income tax return to the individual investors, and those individual investors then will report those income deductions and credits on their individual tax return and pay the tax at the individual level. It's not like a corporation that pays tax at the corporate level. So those deductions and income and credits come through to the individual. The distributions of cash flow out of the project are really not taxable events unless the investor has no tax basis in their partnership interest, meaning that they have a capital or an equity basis in their investment. Let's say you put $100,000 in, and let's say you got $100,000 of tax deductions, then you would have no basis. And so if you got $100,000 of deductions or $100,000 of distributions, you essentially have received cash and you've already deducted your investment in the business. And so that distribution could be taxable. In this case, it is not likely for the length of the project, because over a 10-year period, there will still be debt on this project. And that debt will be qualified non-recourse financing because it's real estate that will provide credit basis, debt basis, if you will, in the project. And so those distributions likely will not be taxed. Those distributions of cash likely will not be taxed. What will happen is they will reduce the capital account of the investor. And at the end of the project, what will happen is there will be a final K1, and all the sale proceeds, the liquidation and distribution proceeds will be tabulated on the K1s, will be tracked. And to the extent that you've received more in cash economically than what you put into the investment, that's what you will pay the capital gains on.
So, Steve, by way of an example, very easy math, if someone invests $1 million and they, let's just say, get $100,000 distribution in 1 year, they then would reduce their tax basis by 100,000, thereby being 900,000 the following year.
Correct.
If they continue to get those $100,000 distributions for the next 9 years, then their 900,000 goes to zero. And at the end of the period when we sell, their tax basis, as you discussed, would be then zero.
Correct.
Okay.
And so then if the project sold for, and I'm just making up numbers, right? So if the project sold for $2 million, now they had the benefit of the $1 million of deductions over the 10-year life of the project, right? They got those deductions. So they got the deductions that reduced their basis. And then when they sell the project for $2 million, they're paying tax on $2 million because they've taken $1 million of deductions. They're paying tax on $2 million of gains, if you will. So then that is $1 million. And that is essentially depreciation in the project. They invested $1 million, they got $2 million back. That's the net that they're paying tax on, the net capital gains from the sale, less the deductions and credits, et cetera, that they took over the life of the project.
Okay. So our next question here is, what year does an investor get the tax benefits discussed in this webinar? And
so
maybe you can answer that on a broad level, and then for the specific credits and deductions for the sustainability stuff, we'll discuss in the next question.
Sure. So in general, the depreciation deductions that we talked about for the cost segregation, the bonus, the bonus deductions, not the excess depreciation deduction, the bonus deductions, the Section 179D energy efficient commercial building deduction, the Section 48 energy property investment tax credits, the Section 45L new energy efficient home credit, all those basically are realized in the year that the project's placed in service. So that year, that first year, you're receiving significant credits and deductions when the property's, available for tenants and has the occupancy permit and it's placed in service. So that's when the deductions and credits initially arise. Now, the rest of the depreciation, besides bonus depreciation, will be over the 5, 7, 15, 27 and a half year life of the building for depreciation purposes. And so those credits, and again, here's where we have to issue the disclaimer of you have to talk to your individual tax advisor, because these deductions from the real estate and the sustainable real estate specifically can be limited because of the passive loss rules. And the passive loss rules essentially say, if you're just an investor and you're not managing the project, which investors are not going to be managing the project, then these losses are considered passive losses, and you can't offset passive losses against investment income or against trade or business income from like your wages or from business that you own through an S corporation or a partnership or something like that. So the losses can be limited. And those passive losses, if they do get limited, it just means you don't get the benefit in that year, but you'll get the benefit in a subsequent year. And ultimately, at the latest you would get the benefit is you would get those benefits when the project is sold. So in a worst case scenario, if there's some benefits that you just never got up front in year one when the building was placed in service, ultimately you're going to get those benefits. It's just not necessarily in year one. And that's where you have to do some planning with your own individual tax advisor based on your individual specific facts and circumstances. And so and there's passive credit rules as well that limit some of those passive credits. And again, they're limited to passive income. So if you do have other passive income from other investments, then the passive losses can offset the passive income from these other investments, and any of the credits can offset passive taxes that you have from other investments, from other businesses and investments that you're in. So that's where it gets a little tricky, and it's specific to the individual's specific tax situation. There are some limitations on business interest expense under Section 163J as well that can limit some of the interest deductions, but there's some planning around that we'll certainly be doing, Nate, with you and your team to address that issue.
Yeah. Yeah, and I just want to clarify back to a point Steve made that with the credits and deductions, if you don't use them in that year the building is placed in service, it's not like you are losing them as an investor. Those will stay on your K-1s. And because it's a pass-through entity, you'll be able to use those in the future. So you don't have to do a bunch of tax planning with your accountants or tax advisors to try to use all of them when the building's placed in service. If you can't use them, it's okay. Steve, moving to the next question, what are the potential benefits to an equity investor in the Edison? And I think we've talked a lot about the cost segregation and the deductions and credits. So maybe I'll move into our next slide, and you could just walk people through kind of how we're currently thinking about this.
Yeah, and these are based on best projections and estimates at the current time. So the Section 48 investment tax credit, the 30% of geothermal at about $5 million is $1.5 million. And again, that's credit. The 45L for the energy efficient home, that's 2,500 a unit, 383 units. So that's a credit of $957,000. The 179D, which is the energy efficient building deduction, and again, that's a deduction, 565 square foot, 418,000 square feet approximately, $2.36 million, as you can see. Cost segregation, again, this is a little bit of a wild card because we don't know for sure what's going to happen after, the current election, and will there be continued phase out. We'll certainly do the cost segregation study to take advantage of whatever bonus depreciation there is. And we'll certainly want to do the cost segregation study to accelerate the personal property tax depreciation, even if there isn't bonus depreciation, and front end load that. And that, 15 to 20% is again a rough rule of thumb estimate, very general, generic estimate on $145 million is $29 million.
And one thing I want to point out is all these, except for the cost segregation, are one time. The cost segregation, the $29 million, just represents the portion that we think we could have as bonus depreciation when the building is placed in service, assuming, as Steve has mentioned, that Congress extends those through 2027. And so as an equity investor for credits, for every $100,000, which is just one share, you would be getting $4,915 of credit in the first year. Now, that's only in the first year. That's not ongoing. And then also as an equity investor, if you invest $100,000, you'll be getting $62,723 as a deduction. And if you remember from our second slide, the deduction, that is based on your ordinary income tax bracket. So you don't have to multiply that by whatever tax bracket you're in, whether that's 20, 30, 40. You'll have to consult with your tax advisor. But it is, I think, something to mention, and we don't project any of these credits or deductions within our IRR or equity multiples. These are kind of icing on the cake for us. So we wanted to lay this out, and also with the disclaimer that we can make very good projections, but obviously things do change, and so it could change. But right now, this is kind of our best assumption for what equity investors in the Edison will be receiving once the building is placed in service. Before I jump into our question 3 that we got prior to the webinar starting, we do have one question. Will the federal tax credit have a sunset? And I don't know, Steve, do you know if the inflation reduction?
I'm not as Nate well knows, I'm not the business tax credits and incentives expert, or one of the many experts at BDO. That's when I bring in my team. I've already brought in our team of experts to help with these. I'm not sure about the sunsetting of those and the time lengths of those off the top. I certainly could consult with one of our experts to look at that, but it really, that's a good general question, but these will not expire before this project is completed. So these are the credits that are in place, absent some, tax law change that would change something. Generally, when there's tax law changes, they don't retroactively change things that taxpayers have already committed to. I mean, it's not law or regulation, but generally legislators have the good common sense not to, if you've already entered into a transaction under a current law and benefit or incentive that you thought you were going to be getting, it's not very fair, or it's not very good public policy to retroactively change that and say, oops, we changed the rules. You really don't get a credit for that. We're not going to give that to you. We're pulling that away. So good question. But as it relates to this specific project, there's no sunsetting or anything other than the bonus depreciation that we talked about that would be applicable to this project or any of the investors.
Well, I know we're at the top of the hour, and I don't want to keep people longer. As we told, it was only going to be an hour. So we really appreciate, Steve, you coming on and educating us about all the different taxes that we can be taking advantage of for the Edison. And thank you, everyone, for joining our webinar live session today. We'll be having these bi-weekly. Our next one is going to be 2 weeks from today with JLL, and we're talking about the capital markets. And we also have recently received several term sheets from both senior and mezzanine lenders for the Edison. So we're going to be also going through those and kind of showing investors our process for soliciting debt from a few different banks. But we really appreciate, Steve, you jumping on, and thank you, everyone, for joining. Have a great rest of your Tuesday.